All right. Good morning, everybody. Happy Webinar Wednesday. We are so lucky to have a guest with us today. I'd like to give a shout out to Patrick, who's joining us from Uprise. He is a CFP and he is bringing all of his expertise to talk about retirement strategies for self employed folks. Welcome, Patrick. Thank you for
Thank you.
being with us
Glad to be here.
today.
Yeah, my pleasure.
Um, we got folks joining. Let's start some chatter in the chat. Where's everybody joining from? What'd you have for breakfast this morning?
I'll go first.
Oh,
I'm from Knoxville, Tennessee, and for breakfast I had three diamond cut pan seared pork chops.
ooh, that is a breakfast of champions. Sandra from Indiana, welcome. Sharon from Georgia. I'm in San Francisco and I had leftover bagels from yesterday, and I'm on my second cup of coffee.
I've been up since 4:30. I've had 8 pot of coffee already, and then I just learned how to make Cuban coffee, like legit Cuban coffee with the little stovetop percolator and all that jazz. So uh,
Oh,
it's good. I'm pretty wired.
delicious.
Got a lot of
Well,
people from Texas.
yeah, we're representing Oscar from San Diego. Cameron is not a breakfast person, or you are and you're just starting the day hungry. Either way, I hope you get to eat soon, Cameron. Paul in Sarasota, you live in a beautiful place. Welcome. Thank you for joining. We're going to give it a few minutes, but I wanted to give a shout out to everybody who comes to these webinars. This session is a result of your feedback and the ask for some retirement specific education. So this is for you all. Thank you. Elaine from Massachusetts, welcome. Patrick. Patrick was just telling me that he's got chickens, and I am surprised to hear you did not have fresh eggs this morning.
Well, my wife uses most of those for baking, and it's getting to be wintertime now, so the chickens are putting out less. But we have these eggs. We do what's called water glassing. It's what the pioneers used to do. So you take eggs, you mix it. I think it's phosphate water. I forget. My wife does it, but it's a way to make eggs shelf stable for a year or two. And she'll, in the middle of the winter when there's no fresh eggs, take one out of there, and it's fresh. The only difference is the yolk's a little bit less solid. But she makes fresh bread, everything all year long. It's
Oh
amazing.
my gosh, you guys are living that life.
I'm telling you.
Sounds delicious. All right. Well, we're going to give it maybe one more minute to let folks join. We've got some great information for you today. We're really focusing on who Collective is built for. So if you're new here, you haven't heard of Collective, Collective is a platform specifically for businesses of one. So if you're a freelancer, self employed consultant, everything that we do is really surrounding this business of one model and how the tax code would apply to your more simpler tax profile. So anything we speak to today is not to say like it's the blanket rule. If you're a bigger business, some of this may apply, but we're really focusing on the business of one model. The way these sessions are structured, we're going to start with some real brief presentation style slides, and then the fun part, we're going to turn it over to live Q&A. So it's a great opportunity to pick Patrick's brain. No bad questions here. If it's related to retirement, if you have, a one-off question on how it ties into an S Corp, Patrick and I can tag team and make sure we get your questions answered. We do ask that you use the Q&A feature within Zoom. That way we don't miss your question. But we've got a good group going. Highly encourage participation. No bad questions here, and we're gonna get going. So today we're going to cover retirement plans you can still set up for 2025. So this is real focused on what opportunities are left for this tax year, how contribution limits are calculated, and then the deadlines for 2025 retirement contributions. And I'm going to leave this to the expert. I'm going to turn it over to Patrick. Patrick, you can cue me when you're ready for the next slide.
Let's roll. Let's get into it.
All
And
right.
like you said, this is focusing basically on the rules on what's possible. At the end, we're going to talk about some advice and how you should absorb this into your own plan. So we're going to go very sort of academic at the beginning. So you go ahead, please, and hit the next one.
All right. So retirement plans you can still set up for 2025. It's all you, Patrick.
All right, very cool. So most of these you've probably heard of, the SEP IRA and then the solo 401k. So the SEP IRA is actually, if you have any sort of existing relationship with a tax professional, you've probably already been told about this one. And I say it that way just real simply because when you look at the professions in this industry, tax people and planners, we're both professionals and we both help you, but we have two different perspectives that actually color some of the advice. And what I mean by that is tax people on purpose are built to look from today backwards in time. That backwards view is how you close books, it's how you do taxes. It's very, very critical. But it means when that same professional tries to pivot and look to the future, their planning is shorter term. It's really that next tax return. So most of the time, not all the time, but most of the time, a tax professional thinks in terms of immediate tax deductions. So an SEP, simple to set up, very low cost, fits the bill. It's a great thing for a lot of people. Now, the other one is a solo 401k. As a planner, planners don't look backwards. We can't plan for what's already happened. So we are constantly attempting to look into the future, whether it's a year, 10 years, 30 years. The reason most planners like the solo 401k is it gives you more flexibility. So you can do the pre-tax side or you can potentially do a Roth side. Like it says here, there's other things like loan provision and stuff like that. But the reality is that's very plan driven. The thing to keep in mind from the very high level is SEP is simple, easy, accepted a bunch of places, get a tax deduction now. Solo 401k gives you flexibility, and there's a few places that do them. Actually, there's more than a few, but I hope that's helpful. Go ahead and roll on to the next one. All right. Now, this is from the tax perspective, this seems like a no-brainer, but this is something that sometimes slips past business owners. And I think it's really because of the way it's explained. So from a high level, if you are an S Corp, the thing to keep in mind is why you set up the S Corporation. And the shortest way to think about it is it's to reduce your overall tax burden. And you do that by having a W-2 wage that has to meet what they call reasonable income. That's the minimum amount. And then when you do that, you only pay that self-employment tax on the W-2 income. The other profit that you make is still your money and you still pay income tax on it, but you avoid that self-employment tax. So when you're looking at this, avoid setting your wages too low, too high, or align the contribution. Keep it simple. What's too low? Well, the first place that's too low is the IRS, right? You want to make sure you're at least hitting the minimum income. But the second thing is, if you even though the IRS may let you set your income level lower than you need to live, quite frankly, you could actually hurt yourself by limiting how much you can put into your retirement accounts. So the right level is first, don't get in trouble with the IRS, but also pay as little taxes, as little extra taxes as you can get away with while still meeting your own personal goals. Make sense? All right, cool. Let's go to the next one. Okay, these are pretty straightforward. So the way I say this, the mistake waiting until tax season, if you wait until January or on, you are no longer tax planning, you are tax reacting. So that's where tax filing comes in. So a tax preparer, somebody who's filing your taxes, there's really not an opportunity for them to give you advice because it's already happened and they're just telling the IRS what has happened. So start beforehand, always a good idea. Don't react just to the tax bill. Again, nobody loves paying taxes, but there are certain situations where paying taxes now could have massive benefits in the future or vice versa. So understanding why and really the key to tax planning is working within the scope of the law, obviously, but within those rules, determining the best time and way for you to recognize and then pay a tax. That's the reality. You're always going to pay taxes at some point. Let's see. And the last one is not having a clear goal. I put that one in there because as a planner, that's the biggest thing. When you do your taxes, most people could do their taxes 2 or 3 different ways, all of them legal, all of them have vastly different tax implications. So what's right? Well, if your only goal is to pay the least amount of taxes possible, just give your income away. Have no money and you'll pay no taxes. So that doesn't make a lot of sense either, right? So you want to make sure that you pay the amount of taxes that actually get you to your goal and that you fund the appropriate accounts to get you to your personal goal. That means you have to define the goal first. Makes sense. All right, let's roll. We're good. Keep on going. Okay, now I won't bore you by reading this to you, but what I want you to notice is when it comes to taking the tax, actually pretty much everything without the solo 401k is going to be percentage driven to profit. So at the top here, we look at the single member LLC, and so say you have that SEP IRA. So first, you got to look at the net profit, like it says. Then you can take 20% of the adjusted net earnings. That's the maximum that you can put in there. That comes from the business. As you go down, it's driven by your income on everything except for the 401k. Now the 401k again gives you more flexibility because you can put 23,500 in there as long as you earn that amount. And I won't keep repeating that, but you have to actually have that amount of income. If you're an S Corp, it has to be within the W-2 payments to be able to defer it to the 401k. So 23.5, real easy. But with the 401k, you have the option. You can contribute from the employee income to either pre-tax, lowering your taxes right now, or Roth. That decision is not one size fits all, I promise you. And it can change year to year depending on your situation, but it is something that should be thought of on a go forward basis. Now, the other cool thing with the 401k is that you still have the ability to match from within the company. So you can have a little bit of cake and eat it too. And in certain instances, sorry for talking so fast, in certain instances, you can have a solo 401k that allows for what's called a mega backdoor Roth. We won't go into deep detail, but just shortly what that means is you could potentially put as much as $70,000 into a Roth 401k this year without touching your IRA or any other sort of plans. That's just one of the options. Does that make sense? And I saw you come off mute, so I'll shut up.
No, I wanted to pick your brain a little bit more and just expand. It's a question we get asked often, and I think you're a better person to describe what the difference is. But we've got pre-tax contributions and after-tax contributions. So like that's the distinction between 401k, traditional IRA versus a Roth. Can you speak to more about what that means? And then when somebody like what's a profile of someone who would want pre-tax versus after-tax contributions?
So pre-tax, after-tax, and Roth. And I promise you that if there's a CPA listening or an attorney, they might not like exactly how I'm going to explain this, but for you to understand, those are the categories of how not just the money that you're contributing is treated, but how growth from it is treated as well. So when you contribute money, and we call it pre-tax. So keep it simple. You've got the W-2 income, $500 comes out of your paycheck before taxes are calculated. It's added to your 401k. Boom. That is pre-tax. Now, that money will grow tax deferred. But in the future, when you take that money out, it is completely taxable to you at that time. Now, move pre-tax aside. Let's skip over after tax and go to Roth. Roth Roth is a special category of money as well. So same scenario. You have your W-2 income coming in, but this time instead of taking the $500 out first, you calculate your taxes. Then after you calculate your taxes, you take $500 and you put it in your Roth 401k. That money will also grow tax free as long as you get to the retirement age. And when you take the money out, including the growth, it all comes out tax free. So pre-tax is not taxable now, but it and all of its growth is taxable later. Roth is taxable now when you earn it, but everything is tax free later. After tax should only be, in my opinion, this is a Patrick Elliott opinion, should only be used as a very temporary thing, because what after tax is something that's not pre-tax and it's not quite Roth. So in the same example we've been using, let's say you take $500 and you put it into a 401k in what we call after tax. That means you do not get a tax deduction today, but it does not qualify as Roth yet either. when it's sitting in that after-tax portion of your 401k. Now, let's say you invest that 500 rather than converting it, which I'll touch in a second. That money, it grows to, let's just call it $1,000 in the future. All right. When you take the money out of the account in the future, the original contribution, that 500, that after tax, that comes out tax free. That's not a problem. But all the growth is taxable. Now, the issue here is you have to track it. And if you don't do a good job tracking it and you have a problem in the future, the IRS is likely going to assume that it's 100% taxable on the distribution. So the Patrick Elliott opinion of when you use after tax is simply a gateway. If you have either a limitation, you've put in too much of you put in 23,500 of a Roth contribution to your 401k and you want to put more money in Roth, or if your earnings are too high and you're doing a backdoor Roth IRA, what you do is make a non-deductible contribution or an after-tax contribution to whichever retirement account you have. You literally just wait for the check to clear. No matter where you have your 401k, there's going to be a 3 to 5 day holding period. That's simply because the money is funded through what's called an ACH, the bank. It can be pulled back. So they just want to wait till the money's actually there. Once the money is cleared for trading, do not invest it. You immediately convert it to Roth. So the best use of the after tax is a portal to the Roth. Does that make sense, Marissa? I know I gave a super long answer, but I want to make sure it's in context.
I'm learning a ton too. So this I think is helpful context. And if you've got questions to apply it to a specific instance, I know Patrick can expand on that in the Q&A. Something that I have heard is you really want to plan when you're going to pay the tax bill. You anticipate being maybe in a higher or lower tax bracket. And so I think in theory, when you're determining whether or not you want a deduction now for retirement, or if you want to pay the tax later, it's kind of a guess or a gamble on when is my tax rate going to be lower. So I pay a lower effective rate on those distributions when the time comes.
That's 100% the starting place rule of thumb where most people approach it. And what we hear over and over and over again is, hey, I'm in a high tax bracket. I need the tax deduction now. And again, from a tax only perspective, with working within knowns, and this is the key, tax professionals work within knowns, and knowing the tax law as it is, knowing what's going on right now. Yeah, it makes sense that you would be in a lower tax bracket in retirement. Just look at the brackets. But the planning perspective, why a conversation is worthwhile is I would submit to you that younger people, and I'm 50, right? So there's a lot of people that I consider younger, but I would have you think about a Roth, quite frankly. And the reason why, real simple, is the national debt, not a political statement, just a statement of reality. It is growing very, very fast. And if you think about like a neighbor who can't control their credit card spending, we're in a position now where we're basically just paying the minimums, and we have to hope interest rates stay low. If interest rates go up, or if we continue with our spending, the reality is there's only three options for our national debt. One is a default. That would be massively bad. I'm not even going to go down that road. Just move that out of the way. Let's hope something else happens. So the second option is we could have a situation where the entire government, not a person or a party or a group of people, but the entire government becomes fiscally responsible, meaning that they stop borrowing money and spend less than they bring in taxes to pay the debt down. If that doesn't happen and we don't want to default, there's logically only one other option, and that means all of us pay higher taxes moving forward. So if you come from a perspective that thinks, yeah, that makes sense. I think that given historically we're in low tax brackets, I think there's a very high likelihood that taxes will go up when I try to get my money in retirement. Now you have a valid reason for going Roth, paying the extra taxes now rather than the future. Does that make sense? So two perspectives. One has a lot of guesswork. What I just laid out has a whole lot of crystal ball guesswork. But that's the purpose of having a personal relationship with people so that you can have these conversations. Make sense?
Totally. Thank you, Patrick.
Sure.
All right. So real quick, deadlines for 2025 contributions, and then the fun part, live Q&A.
Yeah, I won't even bore anybody by reading this. This is pretty straightforward, and I'm sure you can see this. But the takeaway here is we have time. So no matter what your situation is, if you've made a contribution, haven't made a contribution, you're not sure if your reasonable comp's too high, too low, breathe. It's okay. We literally have time. You have lots of people here, collective, myself, lots of people that'll help you. Just get help now before it's too late.
And before we turn it over to Q&A, we've got a quick poll. Sarah, if you don't mind pulling it up. This session, again, was directly related to the feedback and the questions you've asked on webinars in the past. And so we brought in an expert on retirement planning. There's another questionnaire at the end of this session. Both of these polls help us build better education for self-employed folks. So if you don't mind taking a quick second with this poll, and then we're going to move on to the fun part. And I see 4 questions in the Q&A. If you have a question about retirement, the slides, self-employment, there are no bad questions here, and we've got double the brain power now. So I welcome you to pick Patrick's brain. You can pick my brain if it's about S Corp's collective, self-employment tax.
I've got these questions pulled up. I'm ready to go when you are. You just tell me.
All right. So we're going to close out the poll. Thank you for participating. Real quick, there's a couple links in the chat. This QR code that we're sharing here on the screen, if you are somebody who's interested in collective, really what we do is we're a back office support system for self-employed folks, whether you're set up as a single member LLC or you're an LLC that's elected S Corp or want to elect S Corp. We help you with all the back office admin tasks. So we can do LLC formation, S Corp elections, and then we move on to the operating side with monthly bookkeeping. If you're an S Corp owner, we help you with the payroll and then help you file your taxes. So if that's something you're interested in, feel free to scan this QR code. It'll take you to a link to book time with one of our advisors. That's my short plug. We're going to turn off the screen share and start answering your questions.
Awesome. Okay, so Abel doing in there, and then, okay, that's going to get moved over. So if you're ready, I'll just jump in from the top and start going down.
Perfect.
Awesome. So Cameron, I have a 401k and an IRA, and I apologize for reading it, y'all. I don't know if you can see what I see, so I'm just making sure we're on the same page. The question is, I have a 401k and an IRA through human interest. Is there a difference between a regular IRA and an SEP IRA in my solo LLC? I think the question, and I want to make sure I'm answering the right question. The difference is one is an individual retirement account. So you have a separate set of rules for that. That's just earned income. You can do spousal contributions, all that stuff. The SEP IRA is for your business. Now, are they different? Yes. Are they the same? Yes. And I don't mean to confuse you, Cameron, because earlier we mentioned what's called a backdoor Roth IRA. I only talked about the mega on the 401k. Please understand, a backdoor Roth IRA can hurt you if you're not aware of something called the pro rata rule. And I don't want to bore everybody, take this offline, but pro rata just means if you have other pre-tax IRAs, and this is the problem, because an SEP is an employer thing, right? But it's still an IRA. So you can trigger pro rata if you have an SEP IRA and you're trying to do a backdoor conversion. So I hope I didn't make the situation worse. I hope that was a direct answer. So let me know if not. Okay, Cameron? Okay, next one. Okay, go ahead.
Oh, go ahead. I can take this next one. JS 23,000 EE. It's an abbreviation for employee contribution. And so oftentimes, well, specifically in a 401k, you split contributions between who's the contributor, you as the employee versus the business as the employer. If you're a single owned S Corp, you are actually both. But it's the distinction on how much you can contribute in an employee portion versus an employer portion. So EE is employee.
I'll do this one if you're okay with it.
Yep,
Carmen?
totally.
Okay. Carmen Hernandez asks, hi, I am already 3 years into retirement. Does this help or benefit me? Well, I think the question you're asking is, does a tax conversation help or benefit? Yes, absolutely a tax benefit, or there could be a benefit for you. Now, what I can't say based on that question is maybe you're retired from your regular job, but you have a side business too. And then yes, there's a lot of things that can be done there depending on what income streams you have, if it's earned, if it's not, if it's passive. So yes, Carmen, I definitely think that you could benefit from at least a conversation. And that's the thing to keep in mind is it doesn't cost you anything to talk to Collective or to Uprise. Have a conversation, ask questions, find out if it makes sense together. If it does, take the next steps. If not, whew, problem solved. All right. Anonymous. I'm cool with this one too. In fact, I'll just keep going until you. Okay. So on Index Universal Life. Now, let me be very, very candid on this. This can quickly turn into a product discussion that makes it seem like life insurance people and investment people hate each other. I want to explain why. People that do investments and CFPs, financial planners, we can't be where we're at without having done quite a bit of that in the past, even if it's not our main thing now. We are not able to guarantee anything. Everything we say is, past performance, not indicative of future performance, all that sort of stuff. So we sometimes have a hard time when somebody sits down and says, "Oh, I talked to my insurance agent and they said I will definitely be a quad billionaire by, age 52." So the idea, as long as you understand what the product is and what the actual cost is, it can absolutely benefit you. The reality, though, is because it is a product, something where somebody else has to make money, it may not always actually benefit you. That is not to say there is not very specific instances, and I have used them for high net worth individuals before, where it can make a lot of sense. It's just sometimes misapplied. Does that make sense? Okay, cool. Yes, we'll have a recording of the session.
And they're posted on YouTube along with prior sessions. So they will you will get an email after the session if you've attended or registered. And if not, you can follow us on YouTube and pull it there.
I think the next one might be for you too, sole proprietors. I don't think they're asking me how to file taxes. I think they're asking about your service.
Yeah. So for people who file as sole proprietor, so no legal structure is formed, your business gets reported on Schedule C. Collective, unfortunately, can only support once you form an LLC, you still file on Schedule C. For tax purposes, you could be called sole proprietor, disregarded entity. So if you're a sole proprietor with a single member LLC, Collective can absolutely help.
For an S Corp, even if we don't make much income, do we still have to pay ourselves? Well, yes, no. And I want to be careful on this one because technically, if you have a low business year, you can basically put that at S Corp into hibernation status, for lack of a better term. And there's also some state specific stuff here. So I'm not going to go much further down the road in details there because it's definitely got some tripwires. But I will tell you this. If you are consistently or don't expect very quickly to make more income, then we should have a discussion of whether S Corp even makes sense for you because you're paying a higher cost. And there's another question down here later that says you're not running a W-2, but you're an S Corp. That's a problem. You literally have to. So I don't want to scare anybody. I'm not trying to freak anybody out, but S Corp is not, it's not a rubber stamp. You don't just do it because I want to start a business. It needs to be thought through and there needs to be real reasons for it. Otherwise, you're wasting money, you're potentially losing opportunities, and you can put yourself in a bind. So both of those anonymous folks, please reach out to us, either me or Collective, because I definitely want somebody to have a conversation with you.
Yeah, and I can add some more context on that question also.
Thank you.
For an S corp, even if we don't make much income, do we still have to pay ourselves through a W-2? So again, to reiterate, once you make that S corp election, you are committing to uphold the new compliance standards that the IRS has in place for having that S corp election. One of those is paying yourself as the business owner what's called a reasonable salary. Really, the rule is if you're taking money out of the business, this is called an owner distribution to use personally. The IRS wants you to have a corresponding salary. So if you're taking money out without a salary, regardless of how much income you make, it can look to the IRS like tax avoidance. You're not paying into the Social Security and Medicare portions of tax that they want to collect on. So the big risk is if you take distributions without a salary, regardless of income, it could be a red flag. If you're at low profit and you're not taking money out of the business, You may not trigger, the reasonable salary W-2 requirement. However, as Patrick mentioned, maybe an S Corp election isn't the right structure for you to be using, and maybe it's generating more operating costs for you than it's worth. And so again, it is more of a planning conversation to determine whether or not that's the right direction for your business to grow.
Thank you. Okay, to what age can I contribute to a retirement account like the SEP IRA? All right, I'm gonna let the tax pro make sure I don't step on a landmine here, but as I remember it on this one, if you're still working, you can do it all the way up to when your RMDs kick in if you're doing a pre-tax. Technically, you could do a Roth, I think forever if you're living at 110, but please correct me if I've said something wrong.
Yeah, some new things are triggered after you hit a certain age, like the ability to contribute more. They're called catch-up contributions, and it could be either 50 or 55. I don't recall, but
Oh, 50 is the catch up, yeah.
yeah, so it can accelerate your ability to contribute or how much you can contribute. In terms of if you're withdrawing from contributions, I may defer and find the answer for that, but I think you can contribute well into older age.
Actually, yeah, look, we can definitely double check that. I think the way you said that's correct. You can contribute, but does it make sense? Because you have to start taking required minimum distributions from other accounts. So basically, you're taking water out of one bucket, putting in the other. So it's definitely a conversation piece.
And just for clarity, RMDs, required minimum distributions, at a certain age, the IRS, the tax code, requires you to start withdrawing from certain retirement funds.
I'm opening more cans. Sorry, I'm trying to shut cans. I'm opening them here. Okay, I have an S Corp. I want to contribute for profit sharing and 401k, but is it possible to contribute without? No, we already said that one. Let's talk about that one offline because here's the reality, and I'm there's 60% sure this could be happening. The way I read this, it's a problem, but you might just be using terminology in a way that's not exactly the way that we view it. So I'm not trying to panic you, but I definitely would recommend you talk to a on this one because this is looking backwards. This is not a planning issue. This is a tax filing right now. How do I stay out of trouble issue? So we're going to leave it at that one. What if I overfund employer side of solo 401k? Just take it, back it out. I mean, the simple thing is you back it out. Is it as easy as just calling up and saying send me a check? No, there's a form you have to fill out, but it's not an end of the world. It's not a huge deal. If you have to take if you were blessed enough to put money in that say you put in $100 too much and the market only went up from there, well, you got to take out the $100 and then you got to take out the portion of the gain that came from the 100 and then you pay taxes, but it's not that big of a deal. What's important is to make sure that you have a go forward process to prevent stuff like that because even though the IRS will tell you that they don't really, look at your history for audits. Yeah, they do. And if you consistently check things, fix things, you're opening yourself up to more headache than you necessarily need.
And just a brief plug for Patrick and Uprise. This is why we've invited Patrick and Uprise to partner with Collective, is so that we can have these proactive conversations. Abel, your question, it starts with understanding how the contribution limits are calculated, and being proactive with where's my salary going to land and where is that going to benchmark me for both sides of my retirement contribution. So it really, again, just to reiterate, it's a very proactive motion to understand and prevent some of these things from happening.
Cameron,
I can take
okay, go ahead.
I can take this one. By joining Collective, will you get this advice? So that's why again we've partnered with Patrick and Uprise. There's a link again in the chat that will invite you to a wait list to speak with Uprise and Patrick. Again, it's a free conversation. If it's adding value as part of your tax planning and financial planning, we want you to take advantage of Patrick's expertise. So it won't be directly through Collective for financial planning, but it will be through a partnership. In terms of what you get with Collective, we're really more focused on how do we make sure you're capturing deductions, right? Retirement contributions turn into deductions. So we can send you to the experts like Patrick to defer to the retirement and financial planning side.
And then this one, either one of us can answer.
This one I can take. Yeah.
Okay.
Oscar, must you register an S Corp with the state? So an S Corp starts, and this is a little bit of context, starts with a legal structure. Typically for collective members, it's an LLC. We generally recommend you form that LLC in your resident state. That's where you're ultimately a taxpayer. And then you add the S Corp election. The S Corp election is a form from the IRS. So at the federal level, many states do what's called a piggyback, where they piggyback off of a federal election and it applies now to the state. Some states have a proactive standalone state level S Corp election. And so it does vary by state. I don't know off the top of my head which ones are standalone elections. If you join Collective, it's something that we'll handle for you, whether it's a piggyback or a standalone S Corp filing. But there's going to be something that tells your state, whether it's a federal election or a state level election, that you are reporting taxes as an S Corp.
I'll, I can take this one because it's really not going to be answerable directly. So, what's the best, cheaper option that does not trigger IRS fees and make life easier for myself, CPA, and IRS? I'm going to tell you how I think you're at what you're asking me, Abel, and if it's not, I apologize. I think we're talking about retirement contributions. What's easier and for everybody? Well, I'm going to assume that you have enough income to justify an S corporation because that's basically what we're talking about here. So if that's the case, and let's also assume that you have no employees, no spouse, nothing. It's just one person named Abel who has a company who's making enough money to justify an S corporation. My opinion, what's easiest, can't speak to necessarily the less expensive because you gotta look at who you're going to put it with, what you're investing in. There's a lot more there, okay? But what's easiest is actually the solo 401k, and that's in my opinion. Now, I'm not again. This is not I'm not in charge of the world, but once you have a W-2 set up and you've got your payroll system, it is fire and forget, just like you're working any other job. And it's the administration, the tax, all the paperwork that is such a pain is done by that 401k provider. So that's what makes your CPA love you. They don't have to worry about all the other stuff. So, Abel, I hope that answers your question, but that's the perspective I'm coming from in answering that. There are definitely other answers that would blow, like other situations that would make the answer I just gave completely foolish. Okay.
If you've talked to an accountant and asked them any question, and it sounds similar with Patrick, the answer is always going to be it depends.
Yeah.
It's,
But
it's
that's the
highly
good thing.
circumstantial. Yes.
But that's the good thing. And that's why you want to have somebody that you can trust and why relationship is so, so important. But let me answer some more questions here. So once I'm registered as an S Corp, can you go back to,
I
I'm
can
going to
take
let
this
you
one.
answer. Yeah, go ahead.
Yeah, I could take this one. When you add an S Corp election, the IRS doesn't want you to, use it and then go back and forth. So it should be treated and planned for as a long-term election for your tax reporting. That said, if something happens where you shut down your business or your circumstance completely changes, there's a revocation process and it's very proactive. There are a lot of steps that go into it after. The biggest point that I'll highlight here is when you revoke an S Corp election, the IRS prevents you from re-electing for 5 years on that same entity. So again, they don't want you to flip flop and say, I want this tax advantage now, but not next year. It's really intended to be a long term position for your business. But in short, yes, you can go back to an LLC. There's a lot of steps that go with it. So really consider the long term goals of your business.
So just for the record, we would have had the exact same answer, just in reverse. I would have started with, yeah, you can, but it just is no fun.
Correct.
Let's see, late 20s, current retirement planning, personal Roth IRA, you have an LLC with 3 employees. Okay, so I'm going to answer from my perspective based only on what I'm looking at here. So we don't keep saying the same caveats. This screams 401k to me, but not solo because you have employees. So it would still be a small plan 401k, but the reason for it is because you're trying to, my perception of this question is you're trying to attract and retain employees using a Roth option. Not everybody has to do it, but if you build a 401k that allows people to have a Roth, that is super, super nice. And that doesn't hurt you to do it. And you can, the other part to a 401k is there's cliff vesting, all this sort of vesting stuff. In general, I think safe harbor is the way to go, which don't worry about the detail. But the answer to this question, my opinion, is a small 401k with Roth options.
I can take this next one,
Awesome.
Patrick. Can we change the election of S Corp back to sole proprietor? Similar to the previous question, if you're running an S Corp and you revoke it, you default to a C Corp, which is not all that advantageous for a single owned business. And then from there, you may start a dissolution process where you dissolve the entire entity and just go back to operating with just yourself and your social security number. There are steps you can take to go back to being taxed as a sole proprietor. It's very proactive. There are a handful of forms you have to file. Yes, you can do it. Definitely seek some advice before doing so.
I Either one of us can do this one too, but I'll just go real quick. The short answer is yes. The only real big caveat, no, there's probably several caveats, but the biggest thing you have to worry about there is making sure that you don't distribute more than your basis, which is an accounting question. It has to do with how much money you put into it, profit. There's a formula. Don't sweat it. We're not going to go into detail now, but the answer is yes, because you're paying income tax on that money anyway. You can take a distribution as long as you don't distribute too much. So that's the best answer there. What did an HSA limits part? Oh gosh, yes, of course, yes, absolutely. If you qualify for a high deductible health plan, absolutely. And that you bring this up in a retirement conversation is super astute, because unless you have my opinion and perception is unless you have actual immediate medical needs and you have to use that money, one of the best things in the world to do is put the money in there and not touch it. Let it grow, because it's the only triple tax free account out there. One of the only ones. It's tax free going in, tax free growth, tax free coming out if used for medical expenses. And guess what? When you retire, the two biggest threats to successful retirement is healthcare costs and taxes, which we've already covered, but healthcare costs. And this HSA could be a huge advantage, not just for the healthcare costs, but in manipulating your tax bracket. So you get money that you need for your expenses, but because the distribution for healthcare will be tax free, your total taxable income stays lower. And now you retain more of your money. And it's just the same old story over and over again. We want to pay as little money as we can to keep you out of jail. That's the short story. Uh, totally unanswerable, to be blunt, because there's so many factors. At what age? The question is, what age should I stop contributing to an IRA or a ROT ITA? I think Roth IRA was the intended thing there, but really, it just depends. And I'll give you an example. You super young, you come up with an amazing mousetrap that pays you millions and millions of dollars by the time you're 28 years old. You may never ever have a retirement account because you have enough assets there that you can put into a brokerage account, pay taxes, and live off of it right there. So that's an extreme example. Another example is somebody who is working, has a business that they just enjoy, a consultant, something like that. They're 70 years old. They don't need the money and they want to let their kids inherit it. So they put it into a Roth so that that Roth gets passed down to the kids tax free. So I'm not trying to be difficult, JS. It's not answerable as it is.
A segue, and we don't have to get deeper into this, but this is kind of an example of how higher level tax planning and transferring wealth, planning goes beyond what happens on your tax bill, on your tax return, right? So this could be a conversation that leads you to, trust accounts and what assets do you want to leave for your family later.
Active tax loss harvesting,
It's
step up in basis. There's a million things. Yeah.
and it's why it's hard to just answer it very clearly. There is highly circumstantial.
But I love these
Um,
conversations. So please reach out.
for sure. And again, Patrick, you can book time directly with Patrick to ask these nuanced questions that are more specific to your goals. Um, the next one I can take, Patrick. If I have an LLC, then is W 2 mandatory? So if you're a single member LLC, meaning your business is lumped into your personal filings, then the way you pay yourself is actually through a distribution where you're just transferring money from business to personal checking. And there is no formal payroll, there is no W 2. In fact, the IRS doesn't allow that when you're reporting your LLC on your personal return. So, anonymous attendee, if you're a single owned LLC, distributions is how you quote unquote pay yourself.
I think that's you too. The next one.
Is collective only for people with S Corps? I tuned in late and don't think I really qualify for one. Anonymous attendee, you are in luck. It's great timing for you to join this session. Collective is now able to support folks with single member LLCs that want to stay single member LLCs. And so previous to this, we only supported LLCs that wanted to do the S Corp election. We've doubled, tripled, quadrupled the amount of solopreneurs we can now support through this new launch. So if you like what you see with Collective, we invite you to schedule time with one of our advisors. If you want to stay a single member LLC, we've got a solution for you.
May I say one other thing about that, the moving forward relationships, things like that. I also want you to know that I'm not the only person at Uprise, and I say that because trust is super important when you're getting planning, and trust is built on like. So let's just be totally candid and say that you met with me and you just hate old guys with gray beards and long hair. No, I'm serious. It's okay. You don't have to justify that. Relationship matters so much to us that just communicate and say, hey, nice guy, could I try somebody else? We have tons of backgrounds here. It's not all just like this, okay? So relationship really does matter. Go ahead.
I love that you said that because on the other end of Collective, if you book a call, we've got a great team of advisors. So a lot of different folks that you can learn from and pick their brains. JS, I'll take this one. At what minimum
Okay.
income does LLC, as an LLC, does it make sense to opt for S Corp? So I'll just preface that with the IRS, there is no income threshold to be allowed to make an S Corp election. A lot of S Corps will operate at a loss for certain years or, $1 million of profit. So it's not a rule with the IRS. Generally, folks are looking for a savings opportunity when they explore the S Corp election. And so the position that Collective takes is, will you save more, or is the saving potential more than the cost to do the extra work? And so generally, we've seen folks find that when comparing the cost of Collective, profit being around 60 to 80,000. So profit is after all your write-offs. That's not the rule, but generally that's where you break even, where your savings potential is more than the cost of the extra work.
And that's definitely a crossover point of agreement from the tax perspective and the planning perspective. If it doesn't actually add value, it doesn't make sense. I'll let you take this one
Oscar,
too.
yeah, I can take this one. Oscar, so am I supposed to set up an LLC before adding an S Corp? I cannot just do the S Corp from sole prop. Great question, Oscar. I'm glad you answered or you asked this question. So an S Corp election needs to be layered on top of an eligible legal structure. And so for the solopreneurs that we meet with, usually it's a single member LLC. So it's in fact a two-step process. A legal entity gets formed first, and then the S Corp election gets added on top. Something I like to share on these sessions is if you've explored the internet and tried to form an S Corp on your own, there are certain popular websites, maybe Zen Business, maybe LegalZoom, where they have a button to push that says form an S Corp. And this can be very confusing or misleading, but what's actually happening when you opt for that is it is going to simultaneously form a legal corporation for you. So that is one of the legal structures. And then it's also going to do the S Corp election on top. So in either instance, whether you click a button to form an S Corp, it's still following that two-step formation process where you're getting a legal structure first and then an S Corp election on top. So Oscar, yes, you need an LLC. You can't go from a sole proprietor straight to an S Corp. I
That's
think
you again.
I can take the next one. No bad questions, and these are all about self-employed folks. So I have an LLC. My CPA says he is filing as an S Corp by using Form 2553. In that case, do I need to run W-2? Is it mandatory? Yes, if you've made an S Corp election and it's effective for 2025, you should have a corresponding W-2 salary, especially if you're taking money out of that business as distributions. The reasonable salary component is a requirement to maintain compliance with your S Corp. If it may be too late if your S Corp election was effective in 2025. It may be too late. Setting up payroll involves employer registrations, quarterly payroll tax returns. So it's a big ask to fulfill payroll requirement needs. If you didn't for 2025, I would be very proactive about getting it set up as soon as possible for 2026.
David, I'll limit it to this one. I'm a 67-year-old insurance agent focusing on Medicare, and my business is doing real well. And then you also have the next question. You just heard you need an LLC before an S Corp. Should I look to continue to an S Corp? So please don't think I'm being difficult. The short answer is I'm not sure what real well means. To be totally blunt there, it could very well mean that, to be frank. But it also depends on how you're getting paid as an insurance agent. If you're a 1099, there's a few moving pieces there. So I think it's definitely worth a 30-minute conversation with either us or collective to just get real specific and not have any gray area. It can't hurt you.
David, something that we've learned from speaking with insurance agents is your brokerage may determine or control how you get paid.
Exactly.
In a lot of instances, especially with brokerages and professional licenses like yours, David, you are required by the brokerage to receive payment directly to the licensed individual. So you as a individual and your social security number versus being allowed to receive payment to the LLC and the EIN. So in your situation, I might check with your brokerage first. The rules are different depending on brokerage, depending on state, on whether or not you can receive payment directly to an LLC. If you can't, and the brokerage requires that the licensed individual gets paid, you may need to stay a sole prop, and then explore the retirement options that go along with that.
It all landed. At the bottom, he said, I will check. So awesome. And then I'll take the anonymous one here if you're okay with it. So, two rental properties, you claim income on your personal taxes, do not have an LLC. However, you're concerned about protecting assets. If you do an LLC, can you just take a distribution to yourself and file on personal income? Do you suggest the LLC sole proprietorship? Okay, a lot going on here. We're actually both going to answer this one. So I'm gonna answer from the very easy side, which is risk management, things like that. So from the estate planning, from the risk management standpoint, many times we recommend an LLC for each individual rental property. Now that was the gold standard for years until the insurance industry has changed. And the reason we used to do LLCs for every property was in case you got sued, quite frankly, and lost, they could only take away that house. But that's because the insurance for homes back then were not great at covering rental properties. So, from my perspective, from liability specifically, I love that being frangible and broken out. Now, the reason I'm going to defer to Marissa on the other one is there's actually a lot of pitfalls. It depends on how the income's quantified, all that jazz. So, Marissa, you go ahead.
Yeah. So from a tax perspective, and I've worked on a lot of tax returns with rental properties held in LLCs or not. Assuming you're the only owner of the LLC, so this whole concept of being a disregarded entity still comes into play. Disregarded entity means that if you're a single owned LLC, the IRS sees you and that entity as one taxable unit. And so, what I've often seen with rental properties is a single member LLC will hold one or a couple rental properties, right, to create that liability, separation. From a tax perspective, it doesn't change anything. So, anonymous attendee, you're putting your rental activity on Schedule E right now. If you form a single member LLC and put those properties in there, it will continue to be a Schedule E. So, it doesn't unlock new deductions. It's really just from a liability perspective, protecting your personal assets from those rental properties.
So there's another rental property question coming up here. And I'll just say from a high level, there's a lot of nuance because there's short-term rentals, long-term rentals, there's material participation in the rental, there's passive income. So really, truly can't answer these without a specific conversation about what you're trying to accomplish, all of your income sources. I promise you, I'm not trying to be weak. There's so much nuance that it really just depends. And then on the reasonable salary, I'm gonna let Marissa answer in more detail, but from my perspective as a planner, reasonable salary is basically what does that person like what the main role in your job, whatever that is, what does that role get paid within a 150 or 200-mile radius? What's the average believable range? There's a default, people use percentage of income, but Marissa as a tax professional will likely have a much more nuanced answer. So go ahead.
Yeah, so it depends. What's really not helpful is the IRS doesn't have a clear formula for determining reasonable salaries. The guidance literally says reasonable salary, and that's the extent of it. What we found from court cases and reviews and audits is that it's highly circumstantial and that you document how you arrived at your reasonable salary. Um, Comparable salaries based on your region, your seniority, whether or not you're full time, part time, are all factors that you should consider in landing on a reasonable salary. I will say that it is flexible. So when you set up an S Corp and you set up your own payroll, you have the ability to skip a payroll if maybe you lose a client or you fire a client. You have the opportunity to run an off cycle bonus if you pick up a new one. So you're really, you've got a lot of control with the reasonable salary, but you do want to put some thought into, the initial landing spot. Um, Real quick, I'm going to touch on the rest of the next question that was related to rental properties, but you also touched on farming property, which is best. Farms have their own set of very unique rules with the IRS. There can be sole proprietor farms, there can be single member LLC farms. They have their own tax schedule on your personal return. Sometimes they're reported as co-ops. So highly recommend someone in agriculture, an agricultural tax specialist, to have this conversation about farming.
Call us because we definitely have specialty in that as well. So let us know. We're happy to help.
I may take this next one too, Patrick. If I have an
Okay.
LLC reported as an S Corp, only 2 employees, me and my spouse, we are filing tax in our personal return. Is it okay? W-2 is still mandatory. So your tax profile, anonymous attendee, has changed a little bit. You file 2 tax returns now every year. So your S Corp, when you made that election, it triggered an annual business tax return. It's due every March. It's going to generate a K1. It's going to have the W-2s for you and your wife. And then once you have the K1 and those W-2s that come out of your S Corp, you continue with your personal filing, the married filing joint, and you include those tax forms. The W-2s are essentially how you funnel that S Corp income through to your personal return and ultimately pay the tax. So paying yourselves W-2 if you're actively participating in this S Corp business and or you're taking money out to use personally via distributions, the reasonable salary and W-2 requirement will still stand. It may not be required for both you and your wife. It may just be, whoever is the officer or who's participating in generating the income. But one of you should probably take a reasonable salary and it ultimately gets reported on your personal return.
Also keep in mind that since you're married, you can still have a solo 401k, which is neat. Since you're the solo is for the owner only. The exception is the spouse, if working in the company, can also do the 401k. So that's a huge opportunity for the both of you. I'll let you do this one too. It's all
Yep.
you.
If I file a Schedule C and no payroll is on, and no payroll is only the employer component available to calculate owner K contribution. If I bear with me, Susan, I'm going to reread this question. If I file a Schedule C and there's no payroll, so different businesses to file Schedule
Ah,
C is a contribution based on the net profit. I see. I may need some clarification on your first question, Susan, but Patrick may be able to support on question
there's a
2.
lot here. Yeah, I mean, you could be looking at a holding company. I know you're probably getting tired of this, Susan, but it depends. It depends on a lot of things. It depends on how the income comes in, how they're related. It may make sense to have different companies, different all kinds of stuff. So I'm just going to leave it at that. Say, please give us a call. We can get you an actual answer, either collective or us. Doesn't matter. This is something that we just need to have more information on.
Yeah, Susan, you bring up a great point. When there's a lot of moving parts, multiple businesses, different revenue streams, the tax planning gets to be that much more important. So it's a highly nuanced conversation. Sometimes the IRS has grouping rules on like how you can group certain types of businesses, if it's a farm and a farm or a farm and a rental. So there's a lot of considerations and whether or not you can base a contribution limit on which profit. So highly encourage a conversation specifically with Uprising and Patrick. From a tax perspective, at Collective, we would really look at which one of your businesses, if any, fits what Collective is built for to see if we can support you there.
You mentioned in the past, a separate LLC was created for each property that was necessary to take. Yeah, I didn't mean to say that it's not necessary. What I'm saying is we have more options. So as a planner for high net worth individuals over a decade, I've been in this for 17 years. The old, because the old way that insurance policies were written, they were written for homeowners. You had a lot less protection if you rented your home out to somebody else. It just, you had a lot of weirdness in there. So the idea was to get a specific policy that covered a rental property and as a backup to put the property in an LLC, not for taxes. That was a backup plan in case you were sued and lost. And I'm talking about extreme stuff like California is a good example. You have a rental property, you have 30-year-olds that are renting it, right? One night they have a little too much to drink. They walk out on the back deck, trip and fall, and break their knee. Well, what they find is that the stoop is a quarter inch too high compared to the latest rules, right? That type of silliness could get you. It's not that you have to be a bad person or a slumlord. Little things can get you. And if the insurance doesn't cover it and you're on the hook for more than the insurance covers, it ruins your whole personal profile. That was why, at the time, the fallback was always put the LLC. What I'm saying to you right now is if you have a properly structured insurance product, then you don't necessarily have to have an LLC for each one. But truly, still, because redundancy and safety matters so much to a person's nest egg. If you have multiple properties, maybe I'm being overly conservative, but I still really like the idea of at least a couple of LLCs on top of the insurance just to give you protection. So hope that makes sense.
From a tax reporting perspective, I have seen a handful of properties under one LLC. So it's definitely not unheard of. You may put more thought into what that operating agreement looks like and how each property is owned, which may complicate each LLC's formation a little bit more. Um, but otherwise, we've seen it with individual LLCs for each. You may consider, like, if you live in California, $800 for every LLC. So maybe you look at the big picture and say, what's it going to cost me for individual LLCs for properties? There are options, but generally separating that business and personal it is highly valuable. We are over on time. Thank you so much. We've answered 36 questions so far. We've got the last couple. We'll keep going. Patrick, I can take this next one.
Okay.
If I have an S Corp or relocated my business and have not been able to run payroll, but slowly just picking up in the business the last quarter of the year, is that an issue with the IRS? Um, Generally, if you've taken money out of the business to use personally, the IRS wants to see a corresponding salary. So if you don't have payroll set up at all, it takes some time to get payroll set up and actually run. You may be able to do it by year end. I would encourage that if you can. If not, showing a good faith effort is something that the IRS considers. So as soon as you're aware of the need to run a reasonable salary, I would just put the steps in motion to get it set up.
I can do these next two in less than 60 seconds.
Sweet.
Okay. Is it Ali Von Sitto? Awesome name, by the way. I love Von in a name. Can you have both an SEP IRA and a solo 401k? Depends on what you mean. Can they both exist in the real world at the same time? Yes. Should you contribute to both in the same year? No. And I say that because you're conflicting. You're still the same employer and the same shared contribution limit. So you're really not helping yourself in any way. In that point, if you want tax deduction and Roth, which is why you have the solo, just do the solo. It's easier. But if the question is, hey, I had an SEP for 5 years, I just set up a solo. Do I have a problem? No, you don't have. It's just sitting there. You don't have an issue. The last one is on estate planning. I'm just going to say this. I'm not an attorney, so I can't give you legal advice. However, it's not a big deal. The question is, if I have a trust and I have rental properties, and I currently have my rental properties in the trust, if I then go out and set up an LLC and move the properties in the LLC, have I messed up? If that's where you stop, yes. But simply you just have your trust own your LLC. So it's the same thing. It sounds like you have a revocable living trust you can put assets into and take it out. So you would just do that. You would create the LLC, Patrick and Marissa LLC, as the company. You would then move the property, the title into that LLC, but the LLC would be wholly owned by your revocable living trust. Told you I could do it.
Amazing. One more quick one in the chat. Is
Okay.
100 month per salary reasonable? If you annualize that, that's $1,200 as a reasonable salary. Frankly, I would say reconsider.
Yeah.
This can be a flag for the IRS. And from a planning and retirement perspective, you're not really giving yourself a lot of options to maximize contribution limit if you're looking at that lens. So both risky on the S Corp compliance side and limiting, the contribution potential with retirement planning. We did it, Patrick. 39 questions. Thank you again. Every time we do these sessions, the participation is so valuable. You asked for this session to be focused on retirement, and we were able to do it with Patrick's support and Uprise. If there are more topics that you need some expertise on, please always give us feedback. There's going to be one more survey at the end of this session. Both the links to schedule with Patrick and Uprise and Collective are in the chat. They will also be in the post webinar email that you get shortly. Thank you for joining. Patrick, thank you so much again.
My pleasure. Absolutely love these things. Y'all have a great
Take care.